In 2024 alone, central banks bought more than 1,045 tons of gold, enough to keep a $382 billion market roaring at record highs. And yet, at the same time, headlines kept hinting that gold was quietly being sold, moved, and drained from vaults around the world. So what's really happening here? The answer is far bigger than a simple buying or selling story. Look closer and the picture becomes unsettling. Gold is not disappearing because the world has lost faith in it. In many cases, it is being sold slowly, shifted quietly, or repackaged strategically because the people who run monetary systems are preparing for a world that looks more unstable, more fragmented, and far less trusting than the one we lived in a decade ago. For most viewers, gold looks simple. It is a metal, a store of value, a hedge against inflation, nay, something people buy when markets panic. But for governments and central banks, gold is something else entirely. A reserve asset with no counterparty risk, no promise attached, and no dependence on another nation's political choices. And that is why this story matters globally. When gold moves, it often signals that something deeper is moving underneath the financial system itself. Confidence in currencies, trust in institutions, and the balance of power between nations. This is not just about commodities. It is about how the world stores security when paper promises start to feel fragile. Now here's the first twist. The phrase "they're dumping gold" sounds dramatic, but in reality, visible selling is often coming from only part of the market. Exchange-traded funds, tactical reserve managers, one or specific institutions taking profits after a price surge. Meanwhile, in the background, official buyers have been doing almost the opposite. In fact, central banks have now been net buyers of gold for 15 consecutive years, and in 2024, they bought more than 1,000 tons for the third straight year. Poland added 90 tons, Turkey 75, India 73, and China reported 44 tons, even after pausing purchases for several months. That is not the behavior of institutions abandoning gold. That is the behavior of institutions treating gold as strategic insurance. So why do headlines keep suggesting that gold is being dumped? Because the visible market and the real market are not the same thing. What retail investors see is often ETF outflows, vault transfers, or selective official sales. What they do not see as easily is the deeper reserve shift taking place behind those headlines. Take gold ETFs. In early 2024, those funds suffered meaningful outflows, and global holdings even dropped to a 4-year low in April. That looked bearish on the surface. But by the end of the year, strong second-half inflows had reversed most of the damage, leaving only a tiny annual net outflow of 7 tons, with holdings ending almost exactly where they began. That single detail changes the whole story. If you only looked at the first half of the year, you could believe investors were walking away from gold. If you looked at the full year, you would see something more important: hesitation, repositioning, and then renewed demand as the macro picture became harder to ignore. And this is where things take a surprising turn. Some of the gold being sold is not being abandoned at all. It is being actively managed. The Philippines, for example, has openly described gold as part of an active reserve strategy, selling when prices rise in order to keep gold near a preferred share of total reserves. That is portfolio management, not panic. Other sales in 2024 were also tactical. The World Gold Council noted that some central banks appeared to sell modest amounts as prices surged, while buying elsewhere far outstripped those moves. In other words, some institutions were trimming at the edges, while the broader official sector was still accumulating heavily. So let's break this down simply. There are really 3 different gold markets operating at once. There is the public investment market, where ETFs and futures react quickly to rates and headlines. There is the physical trading market, where bars move between London, New York, and vault systems. And then there is the official reserve market, where central banks think in years, not weeks. That last group matters most. Central banks do not buy gold because they expect a good quarter. They buy it because gold does not depend on another country's promise to pay. Unlike bonds, it cannot be printed. Unlike foreign currency reserves, it does not become politically sensitive the moment sanctions, capital controls, or geopolitical conflict enter the picture. But here's what most people don't realize. The modern financial system was built on the assumption that trust could replace metal. In 1971, President Richard Nixon closed the gold window, in ending the ability of foreign governments to convert dollars into gold and effectively pushing the world into a fiat system. That decision was not philosophical. It happened because there were more foreign-held dollars than the United States had gold to cover at the official price of $35 an ounce. That moment changed everything. Since then, currencies have floated, debt has expanded, and confidence has become the real collateral behind global money. Gold did not disappear after 1971. It simply changed roles, from the formal backbone of the system to the silent insurance policy sitting behind it. And when confidence shakes, gold starts talking again. In 2024, the LBMA gold price hit 40 new record highs. The annual average price reached $2,386 per ounce, and total gold demand, including over-the-counter investment, touched a record 4,974 tons. Those are not random statistics. They are signs that the metal is being repriced in a world that feels increasingly uncertain. History gives us another warning. In the late 1990s and early 2000s, Britain sold a large share of its gold reserves near major price lows in what later became known as Brown's Bottom. At the time, those sales looked modern and rational. In hindsight, they became a case study in how governments can misread the long-term strategic value of a reserve asset when short-term thinking dominates. Now compare that with today. Instead of major powers racing to dump gold, many are holding what they have, and emerging economies are adding more. Reuters has noted that the United States still holds over 8,100 tons, while Germany holds more than 3,300 tons. Not because gold is obsolete, but because in moments of systemic doubt, it remains one of the few assets everyone still understands. So what about all those images of gold leaving vaults? That part is real too, but again, context matters. In early 2025, Reuters reported that London vault holdings fell to a 5-year low of 8,477 tons, worth about $772.5 billion, as bullion moved toward the United States during a period of unusual price dislocation and tariff-driven uncertainty. That was not proof of collapsing demand. It was proof that physical gold was being pulled toward the place where pricing incentives were strongest. In other words, gold was not vanishing, it was migrating. Bars were moving from one trusted storage system to another because global finance had created a temporary premium large enough to justify the shipment. What happened next shocked many investors. Even as some funds sold and some vaults drained, gold prices kept climbing. Reuters reported in April 2024 that spot gold hit a record $2,353.79 per ounce, supported by central bank buying, geopolitical tension, and expectations for lower U.S. interest rates. That tells you something crucial. Gold no longer needs broad retail euphoria to move higher. If official institutions keep treating it as a strategic reserve asset, then even selective selling can be overwhelmed by deeper structural demand. And this has real consequences for the modern economy. When central banks prefer gold over adding more dollars or more sovereign debt, they are making a subtle statement about risk. They are saying that inflation risk, sanction risk, and political risk have become important enough that a non-yielding metal may be worth more than another paper claim. For governments, that affects reserve strategy. For markets, it affects capital flows and bond demand. For individuals, it matters because the same forces pushing central banks toward hard assets, debt expansion, currency uncertainty, geopolitical fragmentation, and the declining predictability of policy, are the forces that eventually reach household purchasing power, savings, and investment returns. Now pause for a second and ask the obvious question. If central banks are still buying, why would any institution sell at all? Because gold serves different functions depending on who holds it. A hedge fund uses it differently from a pension fund. An ETF investor uses it differently from a monetary authority. And a central bank with domestic gold production, inflation pressures, or a target reserve ratio may sell 1 month and buy again the next. That is why the phrase dumping gold slowly is misleading. Yes, some gold is being sold. Yes, some vaults are being drained. Yes, some institutions are taking profits. But the real truth is that this selling is happening inside a much larger strategic shift in which gold is becoming more, not less important to the architecture of global reserves. The World Gold Council's 2024 survey captured that mindset clearly. 29% of central bank respondents said they expected their own institution's gold reserves to increase over the next 12 months, the highest level since the survey began in 2018. The stated reasons included rebalancing toward preferred gold levels, concern about crisis risks, and inflation. And there is an even deeper layer here. The World Gold Council also noted that officially disclosed IMF data reflected only 34% of its estimated official sector gold demand for 2024. That means a large portion of central bank activity may not be fully visible in real time. What the public sees may be only part of the picture. This single fact should change how you read the headlines. In gold, transparency is uneven. Some buyers report immediately, some report later, and some barely report at all. So when visible sellers appear in the news, they can dominate the narrative even while hidden or delayed buying continues in the background. Looking ahead, the future implications are hard to ignore. If geopolitical blocs continue to harden, if reserve managers keep diversifying away from concentrated currency exposure, and if debt-heavy economies keep relying on monetary flexibility, gold's role as neutral collateral becomes even more powerful. Not because it generates income, but because it sits outside the promise structure of the modern financial system. That does not mean gold replaces the dollar tomorrow. It means gold becomes the asset countries trust when they want less dependence on tomorrow. And in a century defined by financial interdependence, that quiet desire for independence may be one of the biggest reserve shifts of all. So yes, they are dumping gold slowly, but only if you watch the wrong doors. Behind the headlines, behind the ETF charts, and behind the vault transfers, the larger story is not abandonment. It is repositioning, precaution, and a silent recognition that when the global system feels uncertain, the oldest reserve asset in the world still becomes the one nations reach for first. And as money moves quietly through vaults, balance sheets, and central bank ledgers, the real question is no longer whether gold is being sold, but why so many powerful institutions still seem determined to keep it close.